So the question today is, Anton,
Yes, sir.
interest rates are going up. They're still going up. But I need to get financing. What do I need to know and what do I need to do to get financing in 2025?
There's a crushing reality that's happening right now, and it's interest rates are stupid high, so debt is expensive. And it's got a lot of buyers just straight running for the hills. I'm not going to do this right now. I'm going to wait. But we're going to go through some ideas about like how to turn this chaos into an opportunity. I'm going to cut through the BS. Like the Fed just dropped the bomb. Inflation numbers for January came out hot. So it got worse. I get the text message from you and you're like, you drew the little arrow on it, upward direction. And rates are sky high. So to be honest, on a certain level, everyone's freaking out. So I want to go through this today. Like, why have rates gone up? What's keeping them high? What is the government? What is being done today to lower them? What's working? What's not working? What's the opportunity? And then what's an action plan real quick?
What's the interest rate, by the way, right now?
The interest rate today is a little over 7. And we were just getting ready to creep back under 6. The inflation numbers came out. So the inflation number came out and it missed expectations. Only like 5 of the economists said it was going to come in hot. It came in hot, like 0.5 hot. So it popped to the upside. But here's what's always interesting when you look at this data. If you dig under the hood, and because we've talked about this before, inflation is this CPI is made up of a basket with shelter being one of the main parts of the basket, shelter making up 30%. It still says rents are going up by 5%. Ask any landlord. Is rents going up by 5%? No. But they look at it over a year. So that's one of the things that hurt, but nobody expected it to surprise up as much as it did. Second thing that happened, and Meet Kevin did a really good job of talking about this idea that we could actually be in a deflationary cycle, but the way we measure inflation is so dated, and they actually just revised inflation. So every year, stupid BLS revises inflation, and late 2024 numbers got revised down, but then it caused early 2025 number to look like it popped even higher. Doesn't matter. The market responds to the headline. And if we go into this and we start looking at like, why have rates gone up? Why are rates so freaking high? Number 1 is inflation. Number 2 is economic growth. Number 3 is the labor market, government deficits, and then these kind of global shocks that we went through. Inflation hit a 41-year high in 2022, and then the Fed cut rates. But when they cut rates, President Trump was coming in, there's fear of tariffs, and rates actually respond in a negative direction. So what's happened is with inflation kind of being the number 1 problem here, the Federal Reserve predicted they were going to have 2 rate cuts in 2025. Now, after yesterday's report from CPI, the CME Fed Watch tool is predicting 1 rate cut. So the Fed says 2. Stock market right now is saying only 1. Okay, maybe we're in this higher for longer boat for a second. 2, even with the really high rates that economic growth didn't slow down like it usually does. So usually as they raise rates, it causes economic conditions to slow down because everything's more cost prohibitive for both the consumer and businesses. So it usually slows growth. Our economy kept humming along. And then the labor market, unemployment rose a little bit, but it hasn't risen significantly. I got a question yesterday when we taught a class like, well, what if Doge is successful at laying off these 60,000, 80,000 government workers? That's not a large enough layoff to dramatically affect unemployment. Kind of a couple fringe theories about this. What's our conspiracy theories? What if we're really into some type of market manipulation? What if we're actually in some type of currency war right now with other countries and we're keeping rates higher for longer to exert our global dominance, to exert the dollar being stuck in its position of authority for a longer time? Don't know if that's actually true. Great conspiracy theory.
So I know we're going to be talking about what's keeping them high. what's kind of your thoughts on how high it could get?
It's a really good question. There are pundits who are saying rates could jump up from here. They're saying inflation is still around. So I read the left, I read the right, I read the good, the bad, because what I want to do is I want to understand the market and be able to deliver it to all of you, our subscribers, our listeners. We appreciate you. But if you look at the 10-year Treasury overall, the 10-year is what dictates our real estate debt. It's what dictates consumer debt. If the 10-year goes down, credit cards get cheaper. 10-year goes down, auto loans get cheaper. So all debt. The 10-year peaked again in the last few months, and then it's been trending down. It does look like it's still trending down, even though it popped up. I do believe that we have seen peak rates in this cycle. However, it's going to be longer and more rough and higher for longer than what we want.
Why is that?
The government has been spending like a bunch of drunken sailors. There's so much money inside of the system that the inflation has not calmed down. So the bond market is a forward-looking market. They're trying to price in what's happening. Unfortunately, tariffs, inflationary. Tax cuts, inflationary. So right now, the bond market doesn't believe that the U.S. has its spending and its inflation in order. Therefore, it's saying, cool, give me a risk premium based on 10-year debt. Until the bond market stops believing that the risk premium is necessary, so in other words, they'll have to see more progress on inflation and more progress on the government debt, rates will stay higher.
So what's next?
What's next is, okay, we know what's keeping them high, but let's just talk about reality. It's this really sticky inflation. To get to 3%, that wasn't that bad. To get to 2% has been a long, slow slog, and I feel like I was a little more optimistic in the beginning. Now I've just kind of accepted this reality. I know the consumer here in the Seattle Metro has also accepted the reality. We talked about it before. The bidding wars are back, even with the 7% interest rates, even before the spring market this year. So the consumer is starting to be there, but we're not unlocking that full level of demand because of that lack of affordability. You're still seeing the strong economic growth. There's uncertainty about the neutral rate. It's interesting to hear the Fed debate, the different members of the board debate. And previously in other administrations, like in Greenspan or Bernanke, the Fed was always in unison, and it was like blasphemous for someone to not follow the party line. What's cool now is they're not following the party line. Some are like, yeah, we should cut sooner. Some are like, we're not quite there yet. The idea of the neutral rate, or R star, as it's referred to, is the rate at which the rate at which interest rates are neither restrictive or helping growth. And right now, the Fed believes we are in a slightly restrictive policy, at the 4.25 to 4.5, but they don't. Not everyone believes that. The question is that 25 basis points, 50 basis points, or 100 basis points lower? 100 basis points could be thought of as 1%. Half of the Fed right now is kind of like, we need to come down another 100 basis points. The other ones are like, we're probably there. Jerome Powell was getting grilled in front of Congress yesterday. And Jerome Powell, which I actually enjoy, I think he did a phenomenal job. When questioned about the new inflation numbers as they were popping out, he said, the Fed doesn't react to one reading, two readings. We're looking at the overall trend. And he did a very good job of kind of calming the market down yesterday during his speech, even as, the right does this, the left does this, and they all kind of yell at him. He did a great job keeping that composure. But the neutral rate's kind of unknown. And so the Fed is testing the waters, but where I'll give, once again, kind of Jerome Powell and the whole Fed a little bit of their flowers is even in the face of Mr. Trump, President Trump pushing really hard and people demanding lower rates and other countries wanting us to lower our rates, the Federal Reserve is like, you know what, we're going to wait and see. I applaud that because they're not caving immediately to political pressure. They're trying to do what they feel is best for the whole country. However, policy changes that are coming, aka tariffs and potential tax cuts, could exacerbate this problem and make inflation worse. If you want inflation to go away, you could actually raise taxes. If you raise taxes, the government takes in more revenue, businesses spend less money, consumers spend less money. Now, I'm not for raising taxes, but it would make inflation go away. And then our spending problem. We're $2 trillion extra in debt this year. We've got to get it taken under control. Some of the conspiracy theories or outlining theories in regards to where we're at is having this debt ceiling debate where it hits the national news media on a regular basis is bad for our country. It's bad for our treasuries. It's bad for our interest rates because we have to every year fight, and then there becomes this political grandstanding about the debt ceiling. Also, the consistent, persistent global instability, the Cold War per se we're having with China, the actual genuine conflicts, between Russia, Ukraine, and in Israel with Palestine, that's still keeping rates high. And then what also hit us in inflation was oil kind of popped up again too.
So what do you think rates could go up to this year in 2025? Because I see you got some.
Yeah. So
forecasts.
if we were to forecast it, I think a max rate is 7.25 and a max or a minimum on the low side is 5.5.
So it could go down?
It could definitely go down.
Yeah.
And what's really interesting is I went and revisited this data just to make sure everyone from Redfin at 6.8 to the National Association of Realtors, I mean, no surprise the realtors would be on the low side. They came in at 5.8, but the average prediction to finish, now the keyword is finish, 2025 is 6.33. So that's about 70 basis points or 0.7% less than where we are today. What we were talking about with all of our investors that we were hanging out with last night in our investor class, and we mentioned this to our home buyers here in the Seattle metro, as rates get below 6.5, the market starts to light on fire. As rates crest 7, so let's just ignore the bidding wars for a second here in the Seattle metro, but as rates crest 7, the sticker shock is too big. I mean, it can go from 6.995 to like 7.05, and buyers are like, whoa, that's 7, Anton. That's too high. The beautiful thing is they're predicting them still to go down. But CME Fed Watch Tool, after yesterday's number, predicts only 1 rate cut, and the Fed is predicting only 2 rate cuts.
Not till later in the year.
Not till later in the year. The CME Fed Watch Tool is like September, October rate cut. So we're talking way late. The odds of a rate cut next month in March are like 4%. So we ain't getting one anytime soon, but overall, I'm still optimistic. And overall, I believe this is still like a buy signal. Overall, I'm like, don't wait. Especially in a appreciating area like the Seattle metro. If you're in a non-appreciating area, totally you can wait. But our market's appreciating too rapidly currently.
Well, you said the last time the market is hot right now and kind of hot early. And so if rates aren't going to go down anytime soon, you could potentially see the market still be kind of going.
You will, because we're at in the Seattle metro specifically, we're selling the same amount of homes we did in 2012. So even with the high rates, the level of demand, because our economy is so good, because of tech, because of the ports, because of Boeing and other manufacturing, Amazon, because our economy is so good, that demand is so high. That's not the same for other parts of the country.
Okay, so what's gonna make the rates go down?
Well, here's what they're doing to try to lower them. But part of this is working and part of it's not working. That's the crazy thing. So the Federal Reserve basically cut 100 basis points last year. That did bring rates down for a moment in time. And in third quarter, we saw the lowest rates we had seen in a long time. We were in the low 6s. And everyone on my side of the fence was like, woo, throw the party. Then the tariff talk started coming in. then it looked like President Trump was going to win, and rates literally just went right back up to 7. So the rate cuts from the Fed were working. What's interesting too is, and I'm going to butcher this, Jerome Powell, somebody said something to the effect during the questioning of like, we need housing, we need better rates. And Jerome Powell, once again, I'll give him his flowers on this one. He eloquently said like, hey, I did my job. I cut rates. You guys haven't built enough homes and you can't control the spending. That's not what he said, but he implied that. And that implication of like, I'm doing my job, boys and girls, like, do your job, was pretty awesome, but he was still super polite about it. So you kind of had to read between the lines on that one. He said the Fed's going to take a cautious approach in 2025. In other words, the rate cuts were working, but now, they're kind of on pause. We talked about the CME Fed Watch tool, that the stock market really believes what's happening is, we're only going to get one more rate cut. The fringe theories is that like this idea that the political pressure from President Trump is going to be so big, Jerome Powell's going to cave. Actually, I don't think it's going to happen. And what's very interesting in the last week and a half, if you look at what Elon said, what President Trump said, and what the U.S. Treasury Secretary, I think his name is Bassett, said, I may have mispronounced that. They said, hey, the Fed's doing a good job. We're focused on the 10-year. As consumers, we got to key in on that. When they say they're focused on the 10-year, they're focused on getting the consumer cheaper debt, not just housing. One of the other theories on how they're going to magically solve this problem is that we're going to have such technological advancements in AI, and AI is going to increase productivity. So we're going to lead to this utopia of lower rates and higher productivity. Musk has this formula, and I've been looking at the stuff on X and looking at the Doge website, and there's this cool guy on TikTok that kind of reports on it every day, and he said it very simply. It's this idea that Doge will find $1 trillion in government waste. So boom, you cut that in half. AI is going to stimulate growth, getting rid of the crazy regulations that are crippling business, that cripple that small business. Between these things, that stimulation of growth could lead to a GDP of 2 to 5%. That's going to get the 10-year down. So I love that. I love that idea. And then Trump comes through and says part of this is also our tax reforms. We're going to cut corporate tax rates to 15%. They're going to be the lowest in the world. And come build your products here, and we'll incentivize you to bring manufacturing home. And we're going through a regulatory overhaul. If this works, one, I don't think it'll happen instantly. But two, if the productivity of the United States increases dramatically, and if we cut government waste, which is in turn government spending, the thing to understand is as the confidence returns and the bond market goes down, when they issue the new set of debt, it's actually almost like a 2-for-1, because the debt payment goes down because the interest rate is cheaper, but it's also easier to sell the debt because there's less of it just to the rest of the world. That could lead, like if they hit on all cylinders, and let's just assume they win, that could lead to 3% mortgages. That's not going to happen tomorrow. But someone was asking me the other day, how could we get back to 3%? If the tax reforms are so good, and if the tariffs, this is a lot of ifs. If the tariffs are so good that we're actually winning monetarily based on the tariffs, and if the productivity from AI is up and the government waste is caught, and the tax revenues are up because we're 3 to 5% GDP, we may have no deficit. If we had no deficit and the Fed was keeping rates, you could potentially see 3% mortgages again.
Like when? Sounds like
end of his term.
Oh, yeah. So it's a while out.
It's a while out.
Yeah. So, and the reason I ask is because that is a huge what if.
Yes.
And Black Swan events, all kinds of things. Funny enough, the last Black Swan event lowered rates really, really low. That was actually a good thing for rates.
All major Black Swans lower rates.
Yeah.
So ever since the Federal Reserve decided they were going to come in and save the U.S. economy, ever since then, the Fed just turns on the money printer, go brr, and lowers rates.
The reason I ask that is because if you were just to look at it more simply, when we lowered rates last year, what happened to the real estate market?
It lit on fire.
It lit on fire, meaning like blast off for home prices.
Blast off for home prices, demand, bidding wars, the whole gamut.
So conservatively this year, if rates even go down, it could just stay steady. Like there's a good chance right now that could be steady. But even if it goes down, we're in such low inventory that it pushes home prices up.
Yes.
And that is not good. Even if you do have a lower rate, it's like a wash, right? 100%. Whether you buy now or you buy in November. So that's 12 months out. It's like a big question mark to me based off of your answer. And then you even said, yeah, if this, like, Hail Mary,
yes.
It's like in 3 years from now.
Yeah.
And that's still like a long way. Like we've seen so much change in just the 3 years this podcast has been going on. So I guess what do you do then? What do you do if you have a lot of unknowns and it looks like it's just going to be steady Freddy with rates right now? And even if rates do go down one by the end of the year, it's going to be so competitive because inventory is low. What do you do as a buyer that needs to get financing? How do you plan everything out?
If you're a buyer or you're an investor and you're thinking for the long term, see, short term is a whole different world, but let's assume you're thinking for the long term. Go look at what real estate has done over the last decade in your area. And I can tell you in the Seattle metro, because we've run the numbers here, it was in the 200,000-300,000, depending on where you're looking. And now it's 1.1 to 800, like just insane numbers. And what the S&P 500 do during that same period over the last 10 years did the exact same thing, and it outperformed its historical average. And that was due to money printing. And since we printed more money this time, assume it's going to outperform its historical average. So what I would do is I would follow the latter part of this podcast and I would get my house in order and take advantage while the market's slightly beat up. Once again, yesterday I was kind of asked like, what were the best deals you got lately? The best deals I bought lately were right before the election when there was uncertainty. And I got the best terms, the best prices, and the best deals, and no one else was making offers. Now that the election's gone, there's some uncertainty that's gone. And so now people have a known future. So the market's continuing to improve in real estate because there is an optimism right now that the pro-business administration that is very in the middle, just kind of from a political perspective right now, that feels supported from multiple sides because people are sick of inflation. They're sick of regulation. They're sick of the government telling them what to do. And they want to get back to minding their own business, working, hanging out with friends and family, and doing what they please and get everyone else out of their business. This leads us just right into the next one. Like, what are your opportunities? With high rates, like, how do I find a freaking opportunity here? Private money. I have a call later today to have a discussion with someone who loans private money for actually a long-term deal for a 5-year hold. Why? Because they also believe treasuries are going to go down. And so they're looking to start redeploying their capital in similar ways to get consistent cash flow. And this particular property we're getting ready to refinance is at a lower LTV. So they're very interested in financing it. Next, owner financing. If the bank's offering me 7, what if I could get 6 from the homeowner, 6 from the landowner, 6 from the person who owns that multifamily, or 5? Option agreements. An option agreement gives me the exclusive right to purchase a property during a defined time period for a specific price, but not the obligation. So what if I use an option agreement today to control a piece of real estate that I could then maybe capitalize on when rates come down? Ooh, sneaky, sneaky. Community banks. Community banks are a lot about these relationships. You can do phenomenal things with community banks as you build a track record and a relationship with them. Our community bank loves us. I just picked up the phone. We finished a project over there. We finished the 2 homes. I called our banker who I've known for, holy cow, probably 16 years now. And I said, hey, remember how we got that construction loan? We decided we're going to keep these. Can you look at refinancing these to permanent debt? No problem. Because we have a history and a track record and a relationship that we've built. Also, we get better rates than the general public because of that. This next one, I'm calling them ninja level skilled mortgage brokers. The reason I say ninja level is I'm talking the mortgage broker who's done the creative deals, who can figure out if you're not vanilla ice cream, who's going to shop it around to get you the absolute best rate possible.
Has the ace up the sleeve billionaire friend that wants to do private lending.
Exactly. They have a history and a track record of solving problems for investors, for first-time home buyers, for the entrepreneur who doesn't have the general W-2. We've got people like this inside of our network, but they're gold right now. Condos. And when I say condos, I'm specifically talking for like Washington State, the Condominium Act. What if we could, use the Condominium Act to chop up a piece of property to be able to sell off part of it so we could get part of our down payment back or lower the overall debt necessary in order to service that specific property. This is a really clever one that we're doing right now too. It's called a partial reconveyance. We made an offer on a property to purchase the property with owner financing. We're putting 15% down on it. And with that 15%, we're also wrapping a small underlying mortgage with that. So we're going to build a dadu in the backyard. And we just wrote into the offer that they were going to do a partial reconveyance. In other words, we were going to go get the permit. Once we had the permit, we were going to ask the lien holder, which in this case would be a traditional bank, and the seller to then let go of the backyard. So now I own the backyard free and clear. I've got my building permit in hand. I've got my property on the front financed at a good rate. And now I can build another unit in the backyard. I can then keep that as a rental property or turn around and sell it off. I think a lot of people are also not looking at maximizing their credit profiles. You need to talk to someone who understands credit at a high level if you don't understand credit at a high level. But there are specific tactics that you can do when you know you're going to be getting ready to purchase that will bump your score 25 to 50 points. You got to get in the mid 700s right now. The debt is so expensive. That little extra premium you pay for having credit below the mid 700s is bad. You need to go talk to that ninja skilled loan officer, figure out where you're at, and start working on this. You got to get there. Okay, secret hack, secret tip. One thing to do to maximize this is go to Dear Aunt Tilly, go to mom, dad, someone who's got Alaska Airlines credit card they've had for 20 years. Ask them to add you as an authorized user. So coming out of the great financial crisis, my credit was really beat up. Hey, mom, I know you've got that Alaska credit card. I know you've had it for like 20 years. Can you add me? No joke. Credit score went up 80 points. Why? Because all of a sudden now I had this awesome trend line that was performing. You can look at doing zoning plays, aka adding a dadu, adding an attached dwelling unit, and then look at doing what we call the big boy BRRRR, which is just the BRRRR idea, but you're putting your cash in, then you're refining back out of it. Lastly, how could you benefit from these AI infrastructure wars? This is what I'm calling them. Let me explain. We know the government's going to pump billions into AI. We know that Facebook, OpenAI, Anthropic, all these people are spending millions of dollars on, or billions actually, on data centers, on workers, on chips. Well, if you're somewhere like here in a tech hub in the Seattle Metro, you may be able to benefit from that by buying land near another data center, by buying land where property is cheap, by buying housing where tech workers would work there, or by creating rentals where these tech workers could live. And lastly, and I didn't add it in here, I'm just thinking out loud, the last part of the section is these high interest rates are forcing consistent rent growth. Like I know rent growth is flat right now. But mark my words, in 2026, you will see above average rent growth because of these high rates, the lack of property that's being purchased, and these AI infrastructure wars that are going on. This is probably one of the things that's keeping the economy moving. There's so many hundreds of billions being spent on it. Last, okay, Anton, now what do I actually physically do? What should I do? The old adage, cash is king. Stack up your cash. Pay off your expensive debt, especially credit card debt. Credit card debt right now can be in the upper 20s. You need to go develop those relationships. We're talking the private money lenders, the community banks, the ninja skilled mortgage brokers. Yes, relationships, because you want them to answer the phone when they call. You want them to tell you about that special product they've been working on. You also got to shop around and get multiple quotes. Sometimes these credit unions or these small community banks are running specials on things that could get you maybe a half a point lower. You should then also look at interest rate buy downs. When debt is expensive, how could I buy down the rate? Or maybe you should look at an ARM. An ARM is an adjustable rate mortgage. Right now, we know debt's expensive, but we believe, and so did that giant room of experts, it's trending in a downward direction. So if debt's trending in a downward direction, why don't I just go get a 3-1 ARM or a 5-1 ARM? That means it's going to adjust after 3 years or adjust after 5. So I'm going to get a little bit better rate because the bank knows it's going to float later. I'm just trying to bridge the gap for the next 24 to 36 months so then I can refi into lower debt later. What about, this isn't going to work for everyone, but what about this idea of maybe a shorter term mortgage? Realize if you get a 10-year, a 15, or a 20, the rate is lower. Now the payment conversely is higher, but for some people, this makes financial sense. There's also going to be people who they're in the, what we call the locked in. In other words, they've got interest rates that are super cheap and they don't want to get rid of it. But even those individuals run into financial pressure. So if they run into financial pressure, if you could wrap that mortgage or assume that mortgage and get that low debt? Unfortunately, I just had a discussion earlier today, excuse me.
Looking into the future.
I was looking into the future.
Like that.
I got like listing appointments lined up.
Can you look 3 years to see if that Doge thing works out?
Doge worked out. Look at that. I spoke with them earlier today and 4.125. And unfortunately, just due to financial situations and marriage situations and even a little health thing, it's not working out. And they're going to have to sell. That's a perfect example of a mortgage to wrap or assume. Let's also go back to what we talked about earlier. What about owner financing? What about private money? Realize owner financing and private money can also come out of this cool thing. It's called a self-directed IRA. A lot of investors loan us money out of their self-directed IRAs. So look at talking or having a good conversation with Dear Aunt Tilly or other people who have IRAs who may possibly be interested in lending out that money.
Can you get lower interest rates with private money compared to what a mortgage rate would be with a bank?
You can with certain individuals. So there are going to be, like there is in every field, there are going to be private money sharks that are predatory lenders who want to foreclose on you. Watch out for them and watch out for the hard money guys that do that. There are hard money businesses that's their whole business model. Then there are people who are going to do one or two, and they're looking for low risk. They're looking for consistency. They're looking for security. These people invest in CDs. They invest in bonds. They invest in mutual funds. They're going to look at their private money loan to you as something like that. So yes, it's a great option. How do you know the difference? You actually ask and let go of the judgment, let go of whatever it is you're thinking. Hey, Benji, what is a rate that you think you would charge? And whatever they say, excellent. How did you come up with that? What are your thoughts around that? Your goal is to understand how they're thinking, why they're doing it, and based on that, what type of loan would you feel most comfortable with and on what type of property? A lot of times they'll tell you, if they don't know, you could say, may I show you examples of other deals that we're doing right now and what other people are lending to us? Here's one, here's one, here's one. Because if you've got credibility and a track record and you can show them other examples, they feel more comfortable. This is very much private money and owner financing and money out of a self-directed IRA is all relationships. It's all trust. And so it's all about showing your track record, proving trust, and building a relationship. That is the absolute most important thing. And then do what you said you were going to do. Because if you do it, they will then refer you someone else because they're so happy.
If people have more questions about interest rates and financing, can they call you? And then how do they get a hold of you?
They can reach us at 425-249-0214 and at rsg.com.